and welcome. You're watching Informed Investor, brought to you in association with the National Stock Exchange. I'm Samira Abdi. At Informed Investor, it's always been our endeavor to help retail investors make better choices so that their money is always working for them. And taking that endeavor forward, we've now brought Informed Investor to your workplace, the first of which is TCS House in Mumbai, which is where we are this week. But before we start talking investments, I thought it would be a good idea to catch up with Dr. Ritu Anand, Vice President and Deputy Head Global HR, to try and find out the kind of investment initiatives that TCS has undertaken for their employees.
TCS is an old organization with young population. We have 240,000 people, of which 70% are Gen Y people. So it was morally our responsibility to ensure that while they are on their path of working and earning money, that we put a compensation structure in place which excites them and also educates them towards wealth management. So what have we done is that first we have given them an option for planning their compensation. How much to put in what salary component, how much will go in tax, and how much they can save and take home. So we call it bouquet of benefits, which is embedded as part of the salary for all people. Second is we ensure that as part of their induction, wealth management companies like Capital and some banks, when they meet our trainees for opening their accounts and all, there are sessions, one-to-one sessions which are given to them for making them aware how investments can take place. As employees move into the hierarchy in their tenure in TCS, we have also ensured that there are regular training programs or awareness sessions which happen as they move up. So we have an Ultimatics, which is our company network, which is very vibrant, and it has got people logging in on a daily basis, and we use that platform heavily to make people aware of the type of investments that they can make.
So that was Dr. Ritu Anand with the kind of investment initiatives that TCS has undertaken. But we also have a whole host of employees here who are waiting to have their queries answered. And we're very lucky today because we have two of the foremost financial minds in the industry with us also to answer their queries. So we have Tushar Pradhan and Hemant Rustagi who are going to be taking all the queries. But before we open the floor, I have a few questions. So Tushar, I want to begin with you by asking you that, in situations like this and the way the markets are, what's the best argument that we can, give to people who are not savvy investors, who are just starting out, so that they're more comfortable with the idea of investing in equity and, that they don't go away thinking that equity is this big monster that's out to get them?
I think there's a lot of education that needs to be done in any case. Generally, equity markets are always attracting investors at the peak of the markets. If you take the unfortunate history of most of the time the investors come in, it's absolutely at the peak because they keep waiting. They keep wanting to see proof of saying that can money be made. And by the time a lot of money is made, that's when the move comes in. And as night turns into day, the equity markets are the way they are. They fall off a cliff after that. The advantage that I can say today is that we've already kind of fallen off a cliff, and the only way that one can encourage is that first of all it's an undulating kind of environment. So as much as it might be a little bit of under a cloud at the moment, I think your chances of making money in the equity markets from here on are pretty good, I must say. What is very essential to understand is that equity is a very, very long-term game. And most of the time, The short term is what defines returns for most people, and they either get extremely euphoric and commit capital which they should not be committing to, or on the reverse, they get so shocked by their experience that they never enter the equity markets alone. I think these are the two extremes that most of the investors fall into. And I think a more general interest in this will help them get forward in their goals.
All right, so that's the aim of this show, and we hope that that's what happens here. But Hemant, I want to ask you that a lot of the time, investments do go wrong for people. So for someone who's had, seen their portfolio's net worth probably come off a little bit, since the markets came off, how can it be rectified?
One needs to analyze as to why the portfolio has not performed. Is it that I didn't select well, I didn't invest the way I should have invested, or did I become very aggressive while investing in it? Did I invest much more than I should have invested? I think you need to go back and find out the first reason why when we started investing in. Thereafter, how do you do that? When the markets are doing very well, you tend to invest, suppose you're investing in mutual fund, you tend to invest in funds which are flavor of the month kind of fund. You invest in very aggressive funds, and you kind of change your asset allocation overnight, take out all the money from debt and put it in equity, and suddenly you see that your portfolio has become very aggressive, and that generally takes you beyond your risk-taking capacity. The time has come, obviously, even though this is a level where one should be investing money, but if someone has gone wrong in terms of asset allocation, I think it's very important to go back and see whether I exceeded my risk-taking capacity or not. If that is the case, I think you need to rebalance your portfolio, bring it back to a level which you're comfortable with. It should be in sync with your risk tolerance. Do that. And also, if you have non-performing stocks or funds in the portfolio, you need to weed them out. Or, like I mentioned earlier, if you have aggressive funds, slowly weed them out. Make it more diversified. And I'm sure then once you do that, you will see the asset allocation working for you.
Sure, and Hemant's actually raised a very important point, is for all of us to try and know the kind of risk profile that we have, and to try and make investments and allocations according to our risk profile and age and so on and so forth. But I know a lot of people have questions. Do you want to begin with one?
Given a choice between investing in a inflation-adjusted asset class like say real estate, compared to an option of investing in stock markets, which one will you choose and why?
Actually, it's not that easy a question to answer, because I, for one, will recommend that any investor who's never actually been exposed to the equity markets before should never venture into the equity markets alone like that. It's a place which is quite dangerous. These risks are not something which are visible, and only painful experience will give you an idea of what it is all about. So first of all, I'll step back and say, when you talk about investments, they have to be something which you need to understand first. So I think as an entry for most new investors, a mutual fund or a collective investment, which is a diversified portfolio, is a better way to start rather than saying, should I get into the stock market, should I buy stocks? Coming to real estate, you mentioned it's been beating inflation for some time, but that's not been the case for all the time. One of the other drawbacks, I would say, if you want to invest in real estate, is that most of the times these investments become very concentrated. So you, unless of course you have the means to buy 3 or 4 houses across 2 cities or 4 cities, you're generally saying that all my money, because by the virtue of that investment it is quite concentrated, it will only go into one property. And as you know, certain properties appreciate more, certain properties appreciate less, and your overall return really then depends on that one investment. And that's pretty much, I would say, a very concentrated risk one takes. And the third point I want to make is liquidity. People tend to think that real estate is liquid. So I think one should not get carried away by returns, by what the stories have been moving around, house prices having gone up 3 times, but it's not that easy to actually execute. So when we start off small, when we are trying to save for longer goals in the future, I think real estate is not one of those things that you could possibly do.
So I hope that answers your question. Let's take a very quick break. We'll be back in a bit to keep watching Informed Investor. Welcome back. You're watching Informed Investor. We're at TCS House in Mumbai this week, and we have a whole host of their employees who are here having their queries answered. We have Tushar Pradhan and Hemant Rustagi who are tackling their queries. Hemant, before we proceed and get to the questions, I have just one small question for you. You know, we did a small research over here with every member of the audience who's gathered here. One thing that I noticed, and one thing that we haven't spoken about a lot on this show, is the importance of emergency reserve. How important is it? Because not a lot of people over here, I mean, almost a quarter of the people who've gathered here do not have any emergency reserve at all. Some of them who do, perhaps it's not adequate. So what's a good percentage of your income that should be kept aside as an emergency reserve?
See, first thing I would say that emergency reserve is a very important aspect of financial planning. Why it is important is because when you do financial planning, you establish your goals, you decide for what period you need to invest and what is the target that you need to achieve, which means that you are committing your money for a certain period of time. Why is emergency fund required is that in case you need money for some reason, now you don't want to stop investing because you've already committed some money. And if you do not have adequate emergency reserve, the first thing you're going to do is, if you're investing through SIP, let me stop this SIP, let me use this money, I'll start it later, and that later never happens. So generally speaking, you know, depending on at what stage of life you are, if someone is married, has children, then I think ideally it should be kept around 6 months of monthly expenses should be kept aside as emergency reserve. Otherwise, 3 months is also okay. The reason for that is, like I said, is that you do not disturb your investment process at all. And even that is very important to put it in a proper investment option. You have these liquid and ultra short-term funds of mutual funds, which give you, as we just discussed earlier, tax-efficient returns. So while it's an emergency reserve, it's also important to earn tax-free returns on it.
We have a lot more questions that I know people want answered. You have a question, go ahead.
Considering an investor who has this goal set up as long-term and short-term, as far as my understanding goes, equity is a very attractive option when a person goes for a long-term option. But when an investor in the age group of 20 to 29 wants to get into something for a short-term investment, can he still consider equities, or should he go with the majority choice of FD, which does not really provide you with an attractive return?
Equities do have the potential for higher returns, but you have to remember that the returns in equities don't come in a linear fashion. So for example, I have got an FD. I thought that I will need the money in 5 years, so I bought a 4-year FD. In 2 years' time, I needed the money. So it was easy for me to go and break the FD and get the money back. But if I think I have money for the 5-year term, and I put money in equities, and in 2 years' time I need the money, it is not incrementally going to rise in the next 2 years. It could be much higher, it could be much lower than what you actually invested in. So that's the nature of that asset. So unless you understand the variability in the capital, one should not be encouraged to invest in equity in the short term. As I said, you're free to kind of take a chance. Like a lot of experts might tell you, look, this is a very attractive level, even 2 years is enough. You know, I didn't tell you that, but anyone is free to kind of take that call. You've seen many times that investment returns, especially in equities, are done in a very short period of time. So if you take the year 2009 calendar from January to December, the market, I'm not talking about stocks, the entire market on an average went up 70% in 1 year. So you would imagine, look, if I get that kind of return, you know, all my problems will be solved. But that's 1 year after maybe 3 years of pretty subpar returns. You know, so the return has to be added up over 4 years to say, okay, what is my compounded return over 4 years rather than that period.
You have a question also, go ahead.
I've started earning recently and I've made no such investments. So as a first-time investor, where shall I start from?
Okay, so it's absolutely clean slate for you. Go right ahead.
What you need to do is to begin with, at this stage, whatever goals you can define for yourself today. Okay, you're going to have goals which are going to be some short-term goals, some medium-term goals, and whatever long-term goals you can define, try to define that. Now, why it is important is, the moment you define your goals, you will know, okay, for this particular goal, I need money after 1 year. Okay, for this particular goal, I need money after 5 years, and for this maybe after 15, 20, 25 years. See, the moment you define your goals, you decide your time horizon, which is very, very important. Now, then each of these you have to give a target. For example, after 1 year, for whatever reason you want money, you need to have a target for that, as how much money I need. For each of these targets, set a target for each of these goals. Once you've done that, there is a process called asset allocation. Automatically you can decide. Once you decide asset allocation, go for options which are diversified in nature. For example, look at mutual funds. Mutual fund, whether it's a debt option or an equity option, they are diversified by nature. Also look at options which are tax efficient. Okay, we discussed earlier in the show that these are mutual. When you invest in mutual funds, these are much more tax efficient compared to traditional options. So if you follow this process, I think investing will become very, very simple.
I know, and you're probably thinking, what happens to that holiday I've been planning? But if you're disciplined, you'll enjoy the magic of compounding. And I know Hemant will agree with me because she's starting out early. She's only gained the benefits of compounding over the long term.
Oh, absolutely, absolutely. You can get wonderful results. Believe me, you start keeping aside some money for something that you need after 25, 30 years. You
And
can't
many,
even imagine
many
the kind of
holidays.
corpus you can create.
Let's take a very quick break at this point. We'll be back in a bit. Do keep watching Informed Investor. Welcome back. You're watching Informed Investor. We're at TCS House in Mumbai, and with us this week we have Tushar Pradhan and Hemant Rustagi answering a whole host of questions for the employees who've gathered here. We did a little research earlier on, and when we asked the employees, the audience who've gathered here, how comfortable they are investing in stocks and mutual funds, 53% of them said that they were somewhat comfortable, as opposed to 27% who said they were not at all comfortable. We're about to change that. We also asked them what's the kind of returns that they expected on their investments, and 47% have said they were happy with about 10% returns, which is just a little over the kind of inflation that we're seeing. So we're also about to change that, and we have a whole host of questions that we're willing to answer. The first one, go ahead.
I'm an investor who has just started investing, and probably today we see in today's market scenario there are a lot of foreign investments. So how an investor like me who has just started investing in small terms should select his portfolio that has a mixed balance of domestic growth as well as international market?
For you, the focus has to be on what we discussed earlier, the asset allocation. You should not actually depend too much on what is happening in the market today, whether there's so much money, foreign money is coming or not coming. These are events that will keep on happening in the market. There are going to be stages where more money will come into the market from abroad. There are going to be stages where not so much money will come into the stage. What you need to look at this stage of your life is decide your asset allocation first. First thing you need to decide, how much when I'm talking about financial assets, how much of my money should go into equities first, how much of my money should go into debt, and how much my money should go into gold, if at all, at this stage. Because if you are at the beginning of your career and you're looking at building some corpus, you can wait to include gold at a later stage. So you can basically look at asset allocation between equities and debt. First decide that. Within that, suppose you say, okay, I'm going to invest 60% into equities. Then you need to decide what is the right way of investing in equity. Should you be investing directly into the stocks, or should you take the help of a professional fund manager in a mutual fund? If you are not familiar with the stock market, if you don't have the wherewithal to actually go and invest there, because investing means you should have the ability to select schemes, the stocks. You should know exactly what is happening in the stock market, what is happening in the international market, how the economy is getting impacted, what is the impact of all these onto my portfolio. If you cannot do that yourself, if you don't have that much time to do this, go for mutual funds. Go for diversified vehicles, because mutual funds are a diversified vehicle. Even with a small investment of 10,000 or 15,000, you get a basket of 40, 50 stocks. And there's another diversification is like you, there are thousands and lakhs of investors who are investing in your mutual fund scheme. So go for those options where you get diversified investment vehicle, rather than jumping straight away into the stock market.
And perhaps unless you're willing to spend a lot of Sundays reading and researching mutual funds is the way to go. We have another question. Go ahead.
I just wanted to know how much the market sentiments play a role in an investment decision.
Well, actually, if one has to purely follow the greats in the investment field, they advise you that you should never look at market sentiment. If there is any way to shut out the noise of the market, that's the best way. And there is an example which it's a real life example where as a mutual fund there was an investor who actually had moved his house and he was not actually getting account statements. So he thought that more or less his money was lost and nobody's, going after him. Finally, after about 15 years, he comes back to the mutual fund office and says, look, you guys have forgotten me. I had put so much money in it. I want my money back. So they said, well, since you moved and you didn't inform us, we kind of didn't know where to send the statement, but don't worry, your money is not going anywhere. You just tell me your name and address and we'll find it out. When the statement was given to him over 15 years, he fainted. He said, no, this is not my money, because the compounding which had happened over 15 years was so much that he didn't believe that he could have made that kind of money. But he may not have made that money if the statements had reached him. So what would have happened is, in between, he would have used that sentiment. People would have said, no, this is the right time to get out, or they would have said, whatever they would have said, and it would have forced him to make a decision. So the key to successful equity investing in the long run is to remain invested.
All right, so I hope that answers your question, and that's about all the time that we have on our show this week. But thank you so much for having us over, and thank you so much for the time that you've spent to be on the show as well. And we hope that you're now on your way to becoming informed investors. And thanks also to Tushar and Hemant for taking the time out to be here, and for the active interest that you've shown in investor education. Here's where we'll have to wrap up then, but do remember to keep sending us your questions, and if you'd like to invite us to your corporate campus, do write into us. We'd be happy to be there. Here's where we'll wrap up. We'll see you next weekend. Thanks so much for watching.